Hey everyone, welcome back to Corporate Decoder. Today, MLAAU just filed their quarterly report for the 31st of March 2026, and I am seeing some interesting numbers around their IPO and future plans. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is basically a placeholder trying to find a business to buy, and their latest report shows how much cash they used and how their IPO went. So this is Mountain Lake Acquisition Corp, the CAN's quarterly report. Think of these special purpose acquisition companies, or SPACs, as companies that go public to raise money with the sole purpose of buying another company. They do not have a real business of their own yet. This report is all about their financial health up to the 31st of March 2026. They recently had their initial public offering, or IPO, which is when they first sold shares to the public. Now let us dive into the numbers. The balance sheet shows what a company owns and owes on a specific date. As of the 31st of March 2026, they had about $1.5 million in cash. That might sound like a lot, but remember this is a SPAC, so this cash is mostly to cover their operational costs while they look for a company to buy. Here is a big number, $362 million. This is the money they raised from the IPO that is sitting safely in a trust account. This money is meant to be used for the acquisition, and they cannot touch it easily without certain conditions being met. On the other side, we see liabilities and something called shareholders deficiency. This means as of now, their liabilities plus the shares they might have to redeem are much larger than the value of their equity. For a SPAC, this is not necessarily a bad sign if they are still in the acquisition phase, but it highlights that the company's current financial structure is heavily geared towards its future acquisition. Here we see their statement of operations, which is like a report card for their profit and loss. For the 3 months ending the 31st of March 2026, they actually have a net income of about $1.9 million. How is that possible? It is mostly because of the interest they earned on that $360 million sitting in their trust account. It is smart money management, earning interest while they search for a deal. However, they also had formation, general, and administrative costs of over $228,000. That covers their basic operating expenses. The statement of cash flows is crucial. It shows how money is moving in and out of the company. In the 3 months ending the 31st of March 2026, their operating activities used about $322,000. This makes sense as they are spending money on operations without generating revenue. Their investing activities show them putting $360 million into that trust account. And their financing activities show them bringing in over $361 million from the IPO and private placements. This is the money they raised. So for a company that is not really operating a business yet, their main costs are related to setting themselves up and preparing for an acquisition. They spent about $228,000 on general and administrative costs. These footnotes are where the real details are. They explain everything from how the company was formed to all the agreements they have in place. Mountain Lake Acquisition Corp, the second, was incorporated in the Cayman Islands on the 16th of October 2025. Their goal is to merge with or buy another company. A business combination they have up to 24 months from their IPO date, which was the 28th of January 2026, to find a target. That means they are under pressure to find a deal by January 2028. This is a key part for SPACs. A lot of the shares they sold to the public can be redeemed, meaning shareholders can get their money back if they do not like the deal. As of the 31st of March 2026, over $36 million worth of shares could be redeemed. This is a significant amount that could affect their ability to complete a deal if many shareholders decide to cash out. And here is what is happening now. On the 9th of April 2026, they announced they entered into a non-binding letter of intent, or LOI, to combine with Terra, a quantum technology company. This is their big move. The deal is not done yet. They are still negotiating the final terms. This is a common SPAC play, announcing a potential deal to keep shareholders interested. In the management discussion section, they talk about their strategy. They are looking for a company that is ready to grow and has a strong management team. They also mention the risks, like the ongoing geopolitical events that could affect their search for a target business and the performance of any future combined company. Things like the conflicts in Ukraine and the Middle East can create market volatility and disrupt supply chains, making it harder for businesses to operate and for SPACs to find good deals. They specifically mention the conflicts in Ukraine and the Middle East as risks that could impact their ability to find a partner company and the success of that partnership. This is a significant concern for any global business right now. This is a very important disclaimer. Just because they announced a letter of intent with Terra does not mean the deal is happening. There are many hurdles to clear, like negotiating a final agreement, getting approvals, and completing due diligence. If this deal falls apart, It could negatively impact the stock price because investors might have been betting on this specific transaction. They also remind us that they are listed on NASDAQ but have a deadline. They need to complete a business combination within 36 months of their IPO registration becoming effective, which is January 2029. If they miss this deadline, their stock could be delisted from NASDAQ. This is a common risk for SPACs, and sometimes it leads to a significant drop in stock value. The exhibits list all the legal documents and agreements filed with the report. These include underwriting agreements, trust agreements, and other critical contracts that lay out the terms of their operations and deals. So, what is the takeaway here? Mountain Lake Acquisition Corp. Thucky is a SPAC that raised a lot of money and deployed it into a trust account. They have announced a potential merger with Terra, but it is very early days. The main risks are the geopolitical environment, the possibility that the Terra deal falls through, and the looming deadline to find a business combination before they have to liquidate. The significant interest earned on their trust account is a buffer, but the core challenge is finding and successfully merging with a suitable company. The risk I am watching is whether they can actually close the Terra deal, or if they will need to find another target under increasing time pressure. Alright? That is our breakdown of Mountain Lake Acquisition Corp. The second's latest filing, if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord community linked in the description.